Hi, good afternoon. I'm here to talk about Avesoro Resources. So Avesoro Resources, we're a West African gold producer. We've got operating gold mines in Liberia and Burkina Faso. We're listed on both the AIM in London and TSX in Toronto, and currently have a market cap of around $200 million. Pro forma production last year was 192,000 ounces. 76,000 ounces of that came from New Liberty in Liberia, whereas 115.9 came from Yuga in Burkina Faso. It's worth noting that we didn't acquire that asset until the 18th of December 2017. That acquisition was obviously key to the company. It's doubled gold production. So this year's production profile is 220 to 240,000 ounces at a cash cost of $620 to $660 an ounce, and an all-in sustaining cost of $960 to $1,000. It's worth noting the all-in sustaining cost is high this year. There's around $200 of that that's based on it's capitalised stripping at New Liberty. When we acquired that asset, the management team were approximately 2 years behind on the stripping, so we're working hard to catch that up. We've got a large exploration budget this year. We've got $25 million, and for that we get 171,000 metres of diamond drilling. The reason we get so many metres is because we own the rigs, so we've got 24 rigs operating across our portfolio, and our drilling cost is around $65 to $75 a metre, so significantly cheaper than if you were to use a contractor. How we see ourselves as being different from many of our peers, we've experienced rapid growth to date, and we've got a solid investment track record. The company's grown from 60,000 ounces 2 years ago to 240,000 ounces production this year. We plan to continue growing at the same speed. We've got appetite to do a lot of M&A. We've also got a proven in-house low-cost mine build capability. So our CEO, Serhan Umahan, he was technical director of Koza Gold. He built 3 gold mines during his time at Koza, Turkey's largest gold producer, and he also built the Kokoya gold mine in Liberia, so he's got experience of building mines. We can also turn around assets. The New Liberty asset in Liberia, when we came into that, the operation was losing $88 million a year. Within 18 months, we've turned it around to something that's generating very strong cash flows. We have a major shareholder. Shareholder owns 72.9% of the company. He owns a group called the MNG Group. They're a large contractor across Africa, so they get involved in airport builds, hotel build, operate large infrastructure projects. They're actually building the Accra Airport Terminal in Ghana at the moment. And through this major shareholder, we've got access to low-cost financing. So at New Liberty, we needed to increase the mining fleet. We did it on the back of a phone call, phoned him, had the money the next day, 6.5% interest rate, fixed for 4 years. In terms of our growth, you can see here how we've grown from a 60,000 ounce a year producer to something that's going to do 230,000 to 240,000 ounces this year. We're the 7th largest gold producer listed in London, and by far the fastest growing, with a 3-year cumulative annual growth rate of 55%. In terms of share price performance, this graph shows all our London listed peers. We're one of only 2 London listed gold producers who has a positive share price so far this year. We significantly outperformed the peer group. The big jump in April was when we put our Q1 physicals out, so I think the market took notice and actually realised that we'd grown to something that was producing a fair amount of gold. First half of the year we produced 128,000 ounces of gold. And we see the recent softening of the share price as a good entry point for investment. It excludes a lot of the upside from exploration that I'll come on to talk about shortly. The first half of the year was fairly transformational for the company. As I said, we produced 128,000 ounces of gold in the first half. That's 50,000 ounces more than the company produced in the whole of 2017. We also significantly cut our operating cash costs and all-in sustaining costs by around 40%. That was a direct result of the improvements that we put into place at New Liberty during the period. You can see we generated strong revenues, and during the first 6 months of the year, we've added 29% to our reserves base in Burkina. That equated to 147,000 ounces of reserves, so basically 18 months extra mine life. And in Liberia, we've added 120,000 ounces, or 12%, to our measured and indicated resources. How we performed in the first half of the year, so you can see first half gold production just over the halfway point, 128,000 ounces. It's well on the way to the guidance of 220 to 240. Operating cash costs came in at $658 an ounce, so within the guidance range. All-in sustaining costs were significantly below the guidance. We're anticipating that they will catch up as we accelerate the stripping during quarters 3 and 4 at New Liberty, and probably end the year within the guidance range. Looking at the assets we've got, as I mentioned, we've got the New Liberty gold mine in Liberia and Yuga gold mine in Burkina. When we came into both assets, we've had to cut costs significantly. So we've taken the mining costs down from around $6 a tonne to $2.40 in Liberia and $1.90 in Burkina. By cutting those costs, we've made a lot of ounces economic to us that weren't economic to the previous management teams. And at a $1,300 an ounce gold price, 5% discount rate, the combined NPV is around $370 million. Moving on to exploration now, the last 18 months has really been focused on optimising the assets we've got. We're now in a position where we feel we can grow. So we've got 171,000 metres of drilling. And the bar chart shows you where we're putting those metres. And the target is to convert 1 million ounces this year from resources into reserves. The pie chart on the slide shows roughly where we think we're going to convert these ounces across the portfolio. Quickly moving on to New Liberty, we've just completed an infill drilling program that was based on upgrading the inferred ounces that sit below the $1,300 open pit. We've just started a pre-feasibility study to transition the project from a single open pit to a smaller open pit with a combined underground operation. The PFS should be finished in the first quarter of next year, and we're expecting a significant upgrade to the project economics on the back of that. Continuing in Liberia, we've also got the Diploma Project, which is shown on the slides. That's located 45 kilometres from New Liberty. We've just finished an infill drilling program there, and the rigs have moved to Silver Hills and Matambo, both of which are located within 15 kilometres of New Liberty. Moving on to Diploma in a bit more detail, Diploma's got an existing indicated and inferred resource of 901,000 ounces. The infill drilling program we've just completed was the aim of it was to upgrade around 400,000 ounces of that resource into reserves. We've just started a pre-feasibility trucking study looking at trucking the ore from Diploma to New Liberty for processing, and the plan will be we'll supplement the underground feed at New Liberty with ore from Diploma in future years. Moving on to Burkina now, we've actually got 139,000 metres of drilling in Burkina this year. It's split across Yuga, Balago and Ware. It's mostly infill drilling. The target is to add approximately 50% to the reserves in Burkina this year. When we acquired the asset 2 years ago, the asset only had an 18-month mine life, and we've already managed to push that out to 2027, so we've had significant exploration success there. In summary, we've got a target this year to convert 1 million ounces of resources into reserves to extend our mine lives further. We're keen to do some M&A. The company's next target is to become a 500,000 ounce a year producer, so we need to double in size in the next couple of years. This year we've got forecast gold production of 220 to 240,000 ounces. We've already achieved 128,000 ounces of that, and our operating cash costs are 620 to 660 with an all-in sustaining cost of 960 to 1,000. Thank you very much.